Hello, good morning, and welcome to another exciting time we talk about business. It is Business 360, and my name is Blyden Ukem. On Business 360, we'll be looking at some of key Nigerian stories, and part of a conversation will center around IMF projecting Nigeria's growth higher. We'll also talk about complications that come with Nigeria's inflation data and the methodology towards it. It will be a conversation. But first, FCCPC goes after digital money lenders in Nigeria. We begin from there. FCCPC has commenced a phased implementation of enforced measures in respect of digital money lending DML operators. A statement released by its spokesperson, Odaje Ijagu, has said the enforcement is targeted at those who did not regularize their status in accordance with the Digital, Electronic, Online, and Non-Traditional Consumer Lending Regulations 2025. The Commission had fixed Monday, 5th January 2026 as the deadline for compliance. As part of the approved enforcement framework, the Commission has withdrawn the conditionally approved status previously granted to certain DML operators that did not complete the required regularization process within the transitional period. Consequently, such operators have been removed from the FCCPC's published register of approved digital lenders pending compliance with applicable regulatory requirements. Meanwhile, the Center for the Promotion of Private Enterprise, CPPE, has warned against renewed calls for the introduction of additional taxes on sugar-sweetened non-alcoholic beverages, describing the proposal as harmful to Nigeria's manufacturing sector and the broader economy. The Executive Director of CPPE, Dr. Moda Yusuf, has said while public health concerns such as diabetes and cardiovascular disease undoubtedly deserve urgent attention, the introduction of a sugar-specific tax is misplaced, economically risky, and weakly supported by empirical evidence. The organization argued that the proposal is not properly aligned with Nigeria's economic realities. CPPE warned that imposing additional taxes on sector could have far-reaching consequences, including job losses, declining household incomes, reduced investment, and setbacks to poverty reduction efforts. These companies currently contend with 30% company income tax, 7.5% VAT, 10 naira per litre excise duty, and about 4% national development levy, import duties, ECOWAS levies, and multiple state and local government charges. CPPE disclosed that affordability has already been severely eroded. Retail prices of many non-alcoholic beverages have increased by about 50% in the past 2 years, even without the introduction of any new tax measures. Now we move to Davos as Nigeria can capture global supply chain, says Ogonjiwela. The Director General of the World Trade Organization, Dr. Ngozi Ogonjiwela, has said Nigeria must deliberately target global investors and supply chain relocations to drive job creation, deepen manufacturing, and reduce import dependence. She made the remarks on Wednesday in a short clip posted by Glacier on its X handle from a discussion titled From Scale to Capital, Financing Nigeria's Role as Africa's Digital Trade and Infrastructure Anchor, held at Nigeria House during the ongoing World Economic Forum in Davos. Rising geopolitical tensions, particularly between the United States and China, have accelerated supply chain diversification. Firms are increasingly adopting China Plus One sourcing strategies to reduce single-country risks, although China remains deeply embedded in many global value chains. In addition, tariffs and trade restrictions have incentivized companies to reconsider reliance on dominant suppliers, prompting the relocation or diversification of production hubs. Ogonjiwela maintained that these disruptions present an opportunity for Nigeria to capture a share of global supply chains, but stressed that this would require aggressive marketing of the country to prospective investors. Meanwhile, the shutdown of refineries across Europe and North America has tightened global fuel markets and handed Nigeria's Dangote refinery greater leverage in shaping refined product balances, according to energy intelligence firm PLA. In a report, PLA said the scale of refining exits in Europe and North America has structurally altered supply dynamics, noting that around 900,000 barrels per day of capacity in west of Suez was permanently removed from the system. According to the report, these shutdowns have had far-reaching consequences for global fuel supply as the erosion of baseline capacity reduced operational flexibility and amplified the market's impact of outages, keeping refined product balances tight and margins elevated through much of the previous year. The Atlantic Basin enters 2026 at a structural inflection point. The permanent closure of nearly 800,000 barrels per day of refining capacity across Europe and North America has materially tightened product balances, particularly for middle distillates. Against this backdrop, the market's ability to rebalance increasingly depends on the operational normalization of two late-cycle mega refineries, 650,000 barrels Dangote and 340 barrels per day and Dos Bacchus, both of which were designed to anchor regional supply, according to the report. Still in Nigeria, the Central Bank of Nigeria was expected to conduct its second Treasury bill for January 2026 on Wednesday, offering instruments worth 1.15 trillion naira and strong liquidity expectations. The auction would span the three standard maturities of 91 days, 181 days and 364 days, continuing the Apex Bank's heavy realistic instruments to fund government operations and manage liquidity. Market participants say the outcome will be closely watched for signals on the direction of short-term interest rate, especially amid mixed inflation trends and sustained monetary tightening. Data from the offer secular scene show that 150 billion naira has been earmarked for the 91-day bill, 200 billion naira for the 182-day tenor, while the bulk of the offer, 800 billion naira, is allocated to the one-year bill. Meanwhile, up next, the IMF has raised Nigeria's